The most impactful financial institution in Canada revealed more details about how they're now supporting some of Canada's biggest banks who need help, specifically because they're running into issues with their cash reserves, something that admittedly is pretty important if you're a systemically important big bank. This help comes from the Bank of Canada, who has been lending $16 billion per day to help top up these cash reserves. But the question is, why? And what does this mean for Canada and for individual Canadians who hold their money in these banks? To understand this, first we need to understand a concept that keeps on coming up as the cause for a lot of things that are happening today, and that is QE, or quantitative easing. It's something that sounds complex, but it really isn't, and once you understand this, everything else is going to make a lot more sense. In short, the government doesn't just run on the taxes we pay, it has to take on debt to operate. Now, it does this by selling bonds, which are basically IOUs that big banks will buy, because it means that at the end of a set amount of years, the big bank will get their money back from the Government of Canada with interest because they purchased this bond from the Government of Canada, who is selling the bond to raise money to pay for all the various government programs that they're operating. But during the pandemic, it wasn't just the big banks that would buy these bonds. Instead, the Bank of Canada started to buy hundreds of billions of dollars worth of this government debt to keep interest rates low and also to prop up the economy while facilitating the dramatic government spending on various pandemic-related economic programs. Now, when the Bank of Canada buys up bonds, it does so with a special kind of money that it creates out of thin air called settlement balances. It's just a click of a mouse button and this money is there. Now, when the Bank of Canada buys bonds with these settlement balances, we call this QE, or quantitative easing. If you've been following the channel, you'll know we've already talked a lot about the problems with quantitative easing. One of them is that asset prices tend to go up, something that not wealthy Canadians usually don't have exposure to. It'll drive up the prices of stocks and real estate and other assets. And then quickly after, it's followed by consumer inflation, seen in the costs of goods and services for Canadians. These are some of the problems with quantitative easing, but the opposite, which you may not have heard as much about, is quantitative tightening, or QT. Now, this can also cause some issues. QT has led to hundreds of billions of dollars being sucked out of the system over the past 2 years, which, if not handled delicately, can cause some major problems, especially for big banks. Now, these problems are starting to show up, and some of Canada's biggest banks are getting worried about it, and the Bank of Canada, as a result of this worry, is intervening to try to stop matters from getting worse. Now, we're going to get into all of these details and how it could impact you, but first I want to take a second to thank the sponsor of today's video, and that's Moomoo. Many people expect central banks like the Bank of Canada to continue to cut rates over the coming months. Now, this is a result of weak employment data and an inflation rate that's been relatively stable as of late, and it's prompting some people to enter the market, especially in harder assets like real estate, gold, and even large cap crypto like Bitcoin and Ethereum. The global online trading platform Moomoo offers comprehensive tracking of and gives you easier access to these types of investments via ETFs, which track the price of that particular asset. If you don't want to hold the physical asset, you can instead hold ETFs that give you exposure to those sectors without dealing with any of the potential headaches of physically managing or storing your investment. For example, you can search gold on Moomoo to find a list of stocks and ETFs that you could invest in, and you can click into them to get a little bit more information about that particular asset. And if you're looking to learn more about a given investment option, well, Moomoo has integrated newsletters and reports like this one that can help to keep you up to date with what's going on in various markets, and you can even tailor your individual feed to follow whichever subject is most important to you. Now, here's where Moomoo can really benefit you, regardless of if you've already opened up an investment account or if you've never opened one up before. When you open an account using my link in the description and make a deposit, you'll get a $30 cash rebate. And just place an order over $100, and within a couple days, you'll see $30 reimbursed in your account. Plus, if you deposit $2,000 or more, you'll get an additional commission rebate of $200. And right now, you'll also get a boosted 6% yield on any of your uninvested cash under $10,000 for the next 60 days, and that's a rate that's pretty hard to beat right now. So make sure to use the link in the description to open up an account, make your first deposit, and start investing on the Moomoo platform today. So we've talked about how the Bank of Canada put billions of dollars of money into the system via quantitative easing, which is stimulus that helped keep the economy alive when it was shut down due to the pandemic. But back in April of 2022, or at least at the very beginning of 2022, the Bank of Canada finally agreed that the inflation that had reached approximately 8% wasn't just transitory. It wasn't going to go away as easily as they thought. So they started doing two things. First, they raised interest rates at the fastest rate in recent memory. You might remember that. And second, this is what we're going to focus on today, they've been pulling money out of the system now. You can see as this chart has gone down. And this is a result of them letting the assets on their balance sheet roll off. You see, the government of Canada has to pay back the money that was lent to them via the bonds that they issued during the pandemic, those bonds that eventually ended up being owned by the Bank of Canada. But now the government doesn't actually have the money to pay back this debt, so much like Canadians who have mortgages that may expire after 5 years, they have to refinance or take out more debt to pay back their existing debt. Essentially, the government of Canada took on new debt to pay off the old debt, and they did this by issuing new bonds. The only difference is that this time, instead of during the pandemic, the Bank of Canada isn't in the business of buying bonds anymore. Remember, they're letting their bonds expire and not repurchasing new ones. So instead, the bond market's other buyers have to absorb the hundreds of billions of dollars worth of bond supply that's being issued as the government refinances their debt, and a large portion of these bonds are bought up by big banks. Now, obviously, buying all of these bonds from the government of Canada takes a lot of money, but banks and other large funds have an incentive to buy up all of these bonds because of something that the Bank of Canada is now calling the basis trade. Now, this is where people want to invest in bonds because they believe that the bond values are going to go up, right? They're speculating on this financially. They think the bond values are going to go up as interest rates go down. And they've even borrowed money to buy more bonds because they're so certain that bond values are going to go up while bond yields go down or interest rates go down. We've done a deep dive into the details of this trade in a previous video, so you can check that out if you want more details. I'll put the link in the description and maybe a card up here. Now, I believe that absorbing all of the supply of Government of Canada bonds, along with purchasing even more bonds, speculating that their value will go up as interest rates go down, these activities, they take a lot of cash, right? In order to buy these things, you need cash, unless you're the Bank of Canada. And the Bank of Canada has also said that they believe that some funds have even borrowed more money to buy more bonds, which would further reduce the actual liquid cash that's available in the system. It's starting to look like this big lack of cash is going to be a problem. This might start sounding a little bit complex, but it's actually simple. Even if you glossed over the first little bit of that, all you need to remember at this point is that banks and funds are spending billions and billions of dollars to buy Government of Canada bonds, and they're using all of their spare cash to do so. But even though all of this extra cash is being spent, banks still have to have a certain amount of liquid cash, or cash that they have readily available. They have to have a certain amount on hand at any given time due to regulations that have been put in place called capital reserve requirements and stability buffers. They need to keep this liquid cash on hand to make sure that they can continue to operate, right? Continue their day-to-day operations as they normally would, and to make sure that there's enough real cash on hand to prevent average people, the bank's depositors, from ever worrying about their ability to actually take their cash out of the bank. But you may not realize that most banks aren't actually able to make the books all line up at the end of the day. They are often short on the amount of cash that they're supposed to have on hand. And this is something that happens in the normal course of business, and banks have been operating like this for a long time. After a day of operations, they won't have enough cash on hand to meet the requirements or to settle all the transactions that require cash. So, as a solution, the banks will regularly borrow from and lend to each other overnight to make sure that each of them have the amount of cash that they need to on a daily basis. This is totally normal. This kind of overnight lending is called the overnight repo market. When banks lend their extra cash out to other banks who are short on cash, they typically will charge an interest rate, and that's the interest rate that's set by the Bank of Canada here as their policy interest rate. This is the same rate that they recently cut, bringing the Bank of Canada's interest rate to 4.5%, as you can see here, down from 4.75%. By altering this rate, the Bank of Canada controls what rates average Canadians pay whenever they take on debt, because this base rate, let's call it, that the banks pay, well, it trickles down and impacts all of the other kinds of credit products that they offer, be they mortgages or auto loans, business loans, or even credit cards. But this is where the problems start, because it now seems that some banks are unwilling to lend out their extra cash that they would have readily lent out before. They're unwilling to lend out that cash at the Bank of Canada's defined interest rate. Instead, they're choosing to hoard all of that cash at their bank instead of lending it out to other banks who are short this cash in order to get to the amount of cash they need to have on hand as per regulations. This is from CIBC's research, and they're saying that too few people own a disproportionately large amount of cash reserves. And they're saying this also in reference to settlement balances. If you remember that from the beginning of the video, where the Bank of Canada paid for their bonds during the pandemic with settlement balances, this magic money that they created out of thin air, and paid to these big banks. Now they're saying too few counterparties own these settlement balances. And that concentration is a big reason why short-term funding markets aren't functioning efficiently. So some of these big banks aren't lending as they typically would to the other big banks. And as a result of that, the Bank of Canada has decided to intervene. Since some banks won't lend at their preferred rate, the Bank of Canada has decided that they now will become the lender of last resort. They will lend to the banks that are short on cash. After all, it's very important that the public knows that these lending programs are available to the big banks so that they don't lose faith that their deposits are accessible. Now, this is a paper, let me show you, I'll flip over here. This is a paper from the Bank of International Settlements, and it's a paper that the Bank of Canada cites throughout their website as a resource for their development of their own lending programs. And this paper is specifically about how do you manage a situation where a central bank's balance sheet rapidly has expanded, and how do you unwind that? This is one of the largest questions asked by this paper, and I found this part rather interesting. They say the availability of central bank credit also supported banks' access to market funding markets by assuring depositors, this is the important part, by assuring depositors and investors that banks do have adequate liquidity. They've got the cash that you might need to take out. And the Bank of Canada has been ramping up this lending activity, once again being the lender of last resort, who's offering up overnight loans at preferential rates to make sure that Canada's big banks have enough cash on hand on an overnight basis. They did this for the first time back in January, but have been ramping it up over the past months, reaching a new height just over the past week. Now, originally, the bank would only lend $5 billion each day, with a maximum of $1 billion being loaned to any individual given bank. But just a couple of weeks ago, they bumped these numbers up. Just a couple of weeks ago, on Friday, July 12th, they announced that they'd be increasing the dealer and round limits. That just means that now, instead of $1 billion per bank, they've increased that to $3 billion that they can lend per bank, and increasing the overall lending cycle maximum to $8 billion from the previous $5 billion per lending round. And they quickly made use of this increase this week. On Monday, they loaned out $13.35 billion to help banks meet their cash needs. And Tuesday through Friday here, Tuesday, July 23rd, 2024, through to Friday, well, they were lending an average of $16 billion each night. Now, despite the media not really covering any of this at all, maybe because it's complex and maybe because it's designed to be complex so that we don't ask a lot of questions about it, despite that, the governor of the Bank of Canada and the deputy governor of the Bank of Canada did get one question about this at their press conference. Here's Carolyn Rogers explaining why, in their words, they've needed to intervene and do this $16 billion worth of lending each night.
You started overnight repo operations last week. settlement balances are concentrated among Canada's three largest banks. What's going on in the overnight markets, and is it time to wind down QT?
Yeah, I can ask Carolyn to talk about our monetary policy operations.
Yeah, thanks for the question, Randy. So there's, as you point out, there's a couple of different things going on in the overnight market. So we've been in with our regular market operations trying to smooth some of those things out. We talked about this at the last decision. I think there was some pressure on overnight rates as a result of something called the basis trade, cash futures basis trade. We still see some of that activity in the market. What's new since then is Canada has moved to a T+1 settlement on securities, so a tighter settlement on securities. That's increased the demand for overnight money too. And as you point out, there's still what we think to be enough settlement balances in the system, but they're not necessarily in the spots they need to be on any given overnight cycle. So all of those things are putting some pressure on CORA, on the overnight rate for money. And so we're doing what we normally do in those situations. We're coming in with market operations to smooth that out. We don't think we're at a normalized state on our balance sheet yet. We think there's more room to go on settlement balances, but as we do get closer to what we think is a normal state, we'll be paying very, very close attention. We're talking to market participants on a regular basis, so we'll be keeping an eye on this.
And we'll be keeping you updated.
So let's recap a little bit. First, by law, banks need to have a certain amount of cash reserves on hand each day, and they'll regularly borrow cash from other banks in order to top up so that they can have this required amount of cash reserves. Now, number two, there's a lot less cash available to borrow right now. The Bank of Canada has effectively sucked cash out of the markets by not refreshing their bond purchases, right, letting their balance sheet roll off. They've sucked out a bunch of cash from markets, and banks and fund managers are also spending cash like crazy, speculating on bond values and expecting them to increase. And certain banks are allegedly hoarding their cash, refusing to lend it at the appropriate rate. All of this means it's hard to get cash right now. And as a result, three, to make sure that banks who aren't hoarding cash actually have enough cash on hand to meet these requirements, the Bank of Canada is creating and lending out money on an overnight basis to top up these non-hoarder banks. But that does still leave a couple of questions in my mind. Like, why are some big banks hoarding cash? What's that all about? And what does the Bank of Canada's intervention in these overnight lending markets tell us? Well, for both of these questions, we don't really have a hard, certain answer, but I'll speculate a little bit. It would seem to me that banks probably wouldn't want to lend out their cash at 4.5%, the Bank of Canada's overnight rate, when they can instead keep that cash and have it contribute to their extra cash reserves, which then allows them to lend out a proportionally exponentially higher amount via other credit products, right? Like mortgages. If they have more cash on hand, then they're going to be able to lend out more, and they can do that lending at a higher rate, right? Why lend money out at 4.5% to a competitor when you can instead beef up your reserves and offer mortgages at 5.5% or even higher, right? Especially when you know that the Bank of Canada is going to step in to be the lender of last resort to prevent any kind of systemic risks happening from a lack of cash. The Bank of Canada is going to lend to those other banks. We can just keep all of our cash on hand, and it's not going to impact the Canadian economy systemically. And also from Carolyn Rogers' clip I showed you a minute ago, we can kind of gather a little bit about why the bank says it's intervening here. She essentially says that they believe there's actually an appropriate amount of cash in the system, but because of hoarders and because of the basis trade, they're dipping their toes in as the Bank of Canada to just help out until cash is spread out more evenly and overnight markets are acting a little bit more normally than they are right now. See, I think that these kind of central bank overnight lending operations typically only happen in times where lending and bond markets aren't working as they should be, right? They're used to provide banks with liquidity so that they have enough cash on hand to operate, preventing situations like the ones that we saw last year, maybe it was a year and a half ago, with Silicon Valley Bank or SVB, right? By intervening like the Bank of Canada is doing here, so far at least, they've been able to avoid a crunch like SVB at any of the banks in Canada. And if they're able to successfully unwind all of their holdings of Government of Canada bonds, undo all of the quantitative easing that they've done, at least from the assets they've purchased, at least from that perspective, even if they have to intervene in overnight lending markets to do so, it makes it far more likely, if they're successful here, that they'll feel comfortable implementing QE or quantitative easing once more in the future when we might face another major economic disruption. So is that successful unwinding of the Bank of Canada's mass money printing and stimulus operation, or QE, is that a good or bad thing that they'd be able to unwind that without anything major happening? Well, I think it's hard to tell because we can only really see the results of the actions that were taken by the Bank of Canada, not the results had those decisions not be made in the first place. Like, we know that QE added money to the system, devaluing the dollar and increasing inflation while increasing the value of assets that are largely owned by already wealthy Canadians. These actions definitely hurt the most vulnerable Canadians, the people that aren't as financially well off, people who are more sensitive to the prices of things going up and are the least exposed to the benefits of the rising value of shares in real estate and other investment asset classes that tend to hold their value a little bit better when the value of the dollar doesn't hold its value. Like, yes, those things are bad, but at the same time, we can't really know what would have happened if the central bank just abstained from printing money at all. They just didn't do anything, and they didn't inject it into the economy, and they weren't there to prop up the economy during COVID. Like, would we have seen dramatic economic scarring if they hadn't done so? Like, maybe even more businesses would have shut down. Maybe at the businesses that were able to stay alive, maybe more employees would be disconnected from those employers if it weren't for the dramatically low interest rates created by the Bank of Canada and their QE money printing program, right? Like, there were benefits there, but we can't see if those benefits were worth what we're experiencing now. Do you get what I'm going for here? Quantitative easing helped cut interest rates even more, but it also allowed for mass government spending on various programs and wage subsidies, business loans, and direct payment to unemployed Canadians via CERB and CRB. Would we be in a worse off place if none of that stuff happened, right? If none of those programs existed? Or, and this is very possible too, is the inflation and rise in cost of living a more painful result for average Canadians than if the money printing and hugely expensive programs that did help a lot of people, maybe those never existed, and maybe things would have been better as a result? Like, we just simply can't know. Ultimately, in this case, I think it's probably a good thing that the Bank of Canada is intervening, even if it means that the big banks in Canada are not normal market participants where the risks they take on are real, right? The Bank of Canada will tend to bail out these banks because their mandate is to ensure smooth marketing function or smooth market function rather, and to minimize financial stress. It just turns out that this means that they make sure that the banks that don't have enough cash, that they don't have a chance of failing. Right? Their mandate isn't to make sure that wealth isn't distributed from not wealthy people to wealthy people, or from average citizens to the banks. That's not their mandate. It's to make sure that the market keeps on turning as it has, and that we don't see any kind of financial calamity. But you might be thinking, with all this going on, you might think to yourself, should I get my money out of the banks? Should I just hide it all in my pillowcase, hide it in the backyard, dig a hole? And to that, I'd say, hey, you can do whatever you'd like to do. But I'll tell you, I'm not personally doing that, not all the way at least. I agree this whole monetary system seems arbitrary and like it's based on a Ponzi game where debt is stacked atop debt on top of debt on top of debt over and over again. And I'm with you there. It seems messed up. But also, everyone in the world, including the people at the top who are controlling a lot of this, well, they're incentivized to keep that very same game going. And I think that they'll do absolutely anything to make sure that the wheel keeps on spinning, to make sure that that's the case. I'm doing the best I can to increase my income as much as possible, and I'm investing as much as I can in a diversified basket of index ETFs to get broad exposure to markets on a very long time horizon. And I'm trying to own assets that tend to hold their relative value when the value of the dollar goes down, as it does when central banks print money. Right? Those assets could be equity in companies, it could be real estate or blue chip crypto like Bitcoin and Ethereum, possibly precious metals, though I'm not personally as into that, but you can do what you'd like. And I know on this channel I'm always kind of bringing bad news or concerning information, right? But I would warn against doomerism, right? Even if everything is messed up, there's not a lot that most of us can do about any of it. I wish that wasn't the case, but it's the reality. And the way I see it is that we should just do our best to enjoy our lives and to make ourselves and our families comfortable and stable, even if that means having to play a game that we can pretty clearly see the flaws in. That's what I'm doing, and I'm curious what you're doing, and I'm curious what you think about everything we've talked about in this video. What do you think of the Bank of Canada stepping in here to make sure that lending markets keep on operating? Is this kind of like a big deal, or am I making a big deal about nothing? I'm curious what you think. Let me know down in the comments, and subscribe to the channel if you haven't already done so. As always, all the sources for these videos go out to the email list after every single video, so if you want the sources that I've used here, you can check that out with the link in the description for the email list. But with all of that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.